Okay, that was part one. So let's carry on. Remember, the aim here is to decide, or sorry, to arrive at what is consideration, right, for the parent. That's where we're trying to go. What is consideration for the parent who have decided not to just pay cash? They decide to pay in a number of forms. They decide possibly, like you can see here, to pay in the future, but we cannot recognize that future amount. We must recognize the present value. And I'm just going through, I kind of walk through the same example that I've just talked about here. As you can see, you saw me do that calculation. 1 over 1.0 is equal to 0.75, right? Because really, that's what we're ultimately talking about here. So you might get given this figure. Right. Um, and this, like I mentioned, every year you would literally, like you would on any loan, debit finance costs in the income statement and credit that liability because that liability gets added up. Like all you saw me doing is taking the liability and adding on the interest, if you like. Right, if you buy a car, I mean, exactly, same. And in terms of how this would look at the general, when we come to do the workbook, because we're going to go through I'm going to give you the whole work to do for homework. You should put that double entry in. You will debit the investment, and you will credit, if you like, the liability, and that's how it would look at the double entry: debit investment, credit this liability. That's how you would go. And then I sort of go through this. I sort of argue again that you won't pay that. You wouldn't do that because this is what you would pay in the future. We need to do the present value now. Um, so we would be paying 15,000 in 3 years, and exactly. And I assume, but I actually did a proper one where I actually did discount 15,000 over 3 years. Right. And so I've done that for you. Now we have the other option where instead of promising to pay a certain amount in the future, we might want to pay with our shares because our shares, if you like, are a form of currency. They have value. So we want the question here is that you're always interested in is the current value of our shares. That is what they are. That's all share paper is. Share paper is a way of recognizing the value of A minus L, right? So A minus doesn't matter if the nominal value is whatever. That's irrelevant. It's about the market value, which is when I say market value, yeah, market value, the fair value, which is which is the rightful valuation of the value of your business as opposed to the nominal value. That's what you started with. Okay, right. And we recognize this. Well, you might have contingent consideration involving shares, so we must also recognize that as part of equity, and literally under shares to be issued. So, I mean, all we're doing here is trying to understand the credit side of this double entry. Let's look at a normal scenario where a parent does issue shares in return for this investment. So we're very clear about the debit investment side. The problem always is what is the credit? What shares, what equity have we released in our own parent statement of financial position to acquire this organization, the subsidiary? And again, I said here, you're acquiring an asset by issuing shares in your business. You're acquiring a stake in the business by issuing shares. Remember, where our focus, don't forgive me, our focus is on consideration. I'm just trying to work out what the rightful consideration is. What have you rightfully paid for this business, right? Okay. And I've written here, this must be the market value of your shares, as this is the paper or the currency you're using to pay for the asset. And let's see how it works. Typically, I'm just going to go to there is a I'm going to go through to there is a question here. I mean, you have this in your textbook, illustration 2, and it's about a certain character called Jack. And let's read this carefully. You just follow it slowly. Jack acquired. So Jack acquired 24 million shares. I'm just going to go back here. Jack acquired. So Jack took a stake of 24 million shares in this other business in Becky. So we know that he's bought 24 million shares. The question is, how has he decided to pay for it? And tells us that he does this by offering a share for share as part of the full payment. He does a share for share exchange of 2 shares. So in simple language, but it's the same thing. He gives or exchanges. He gives 2 shares in his business, or he issues 2 shares in his organization for every 3 that he acquires in Becky. Right? So this means, right, that if he acquired 24 in total, and he's for every 3 that he's acquiring, he's giving 2, right? He must have given, right, 24 divided by 3 times 2, which is 16 million shares. So he must have issued 16 million shares in his organization. So we know the debit investment, credit, equity, 16 million shares. But they must have a value. So 16 million shares times what? What is the value of his shares? And it says that it has a current market value because it's about value. This nominal value, don't get carried away or don't get waylaid by that, is a current market value of £2. So we are told that there is a current market value of £2, which is 32 million, because that's the value of his shares. So as part of his equity package, or as part of his consideration package, he's offered shares in his business. This is not abnormal. You may have no cash to pay for something, right? Debit, asset, credit, typically bank, but or you could have done it as a loan, but he doesn't. So you just have to be aware. I mean, we will try and do all the different options of ways of paying for something, if you like. But in terms of, this is what we do for share exchange, right? I want to try and stick always within the. So let's do the rest of the other ways that he chooses to pay for this. He also goes ahead to. It says that he also offers a cash payment of $1 per share, payable 3 years later. So for all the shares he's acquired, you can see here, so that's the share for share exchange of 32 million. Then what he says is that I'm going to give you guys £1 for every share I've acquired in you, but I'm going to pay you in 3 years' time. So he wants to pay 24 million in 3 years' time. But like we've just said, 24 million in 3 years' time at 10%, which we're told is the equivalent of saying 24 divided by 1.1 raised to the power of 3, which is where you saw that formula 1 over 1 plus Rn. It's not a formula, we're just discounting the 24 million to today's value. And when you discount that 24 million to today's value, you get the 18 million you can see in that question. That's the 18 million. And that's how he's chosen to pay. You might have had another question that could have told you, oh, he also paid some cash right now, and that's fine. So we can see here that that is his full consideration. I mean, look at the journal. There's a total value or a total consideration from the parent of 50 million. I mean, he could have. So now in the question, what you would now do to complete this question, working 3, is you would now have a scenario where you would have. I'm just going to do it here. You would have the 80%, the parent, 50 million. You would have the 20%, typically using the fair value, if they give you that. They'll give you the fair value. It might be 10, I don't know. And then, of course, you will take away. So now you have the full 100% consideration, as though you own the whole 100%. Then you would have the physical assets of the company, the physical assets from working 2 at acquisition. Maybe that's 40, I don't know. And now you have your full consideration of 20 million. Yeah, and that's how we deal with this. So what we've been trying to do so far was to find out the fair value of this 80%. This is always given to us in the exam, the 20% of the non-controlling interest. Cool, great stuff. We'll stop there and then we'll carry on with this in the next video.